Finish copying, huh? Those who have not copied, raise your hand. Please stop talking. Shh. Finish copying, huh? Right down. The indifference. Enna not exercise. Lapse. No, yeah. Third also, why should I exercise? Third only be lapsing further. I have a right to select 8.0550. Yeah, pound worth what? 8.2796. Exercise and lapse are lap. I sell outside market at 8.2796. They are selling at what? 8.0550. Now, put it there. Now, see. Again, I say, suppose you feel blank, you are not able to understand why exercise lapse, why I put yes, no, etc. Okay. The trick is very simple. If you look like this, you will be getting confused. We write and check, go into the number, you will be understanding it. All the problem I say is lack of sharpness. Lack of what? Sharpness. Class will be listening very sharp here. Sharp means the attention should not be diverted. It should not be what? Diverted. Because every number, it's simple. A number is more or less, sometimes you will get confused. 8.0550 more than what? 8.2796 are not, confusion may come. Now, when confusion comes, ரொம்ப simple. Look at what? Write and see and get the hold of the number before you go for the answer. Are you following? Now, so many things. Again I say, so many difficult concepts. Any difficult concept can be understood by putting trial number into the solution. You put a trial number before, below this, above this, and then see the pattern, be able to understand what? Much more better. That's how the revision and all should be done. Can I proceed further? No. By hearing, don't try that everything can be what? Understood. Hearing and visualization. When I speak now, I said, FSP is more than 8.0550. There is a word called as FSP, the word called as what? 8.0550. Both are not simple English words which I am speaking. That is, I am speaking about two numbers. Speaking about what? Two numbers. When I speak, simultaneously, the two numbers should what? Come to your mind, visualize. Problem is or no? Because you should be very sharp, alert in understanding everything. Okay. I cannot every time wait 10 minutes for you to think and say FSP is what? More or less. Even if I give time, then also you think what? Blank, because you are immune to hearing. Everybody following or not? Now, that sharpness I want, because we are not going to stop here. We are going to continue further for futures also looking what? Same. Stamps are looking what? Almost same. Can I proceed? No, please. Shh. Write down. The indifference FSP between forward and option. The indifference FSP between forward and option is, the indifference FSP between forward and option is, by the formula. What the formula? Forward rate, Tungadaya, is forward rate, fill in the blanks, plus future value of premium. Is forward rate plus future value of premium. Is forward rate plus future value of premium. Is equal to 8.0750. 8.0750 plus what? 0.2045. 8.0750 plus 0.2045. Is equal to how much? 8.2795. Is equal to 8.2795. For asking doubt, don't say, sir, why should we add premium? Why can't reduce? Don't ask me. Check whether what happened with reduce. Then you understand why I should be adding. No. The question on the immediately don't ask. What I say? Put the number check and then what? Ask it. Everybody following not. Again, I am not discouraging you from what? Asking question. I am telling you a way of learning things. No. Next. Situation. In center right? Situation. Now you know whether you are all awake or not. Okay? Situation. Branch it into 3. Situation, branch it into 3. Situation, branch it into 3. First branch. FSP greater than 8.2795. FSP greater than 8.2795. Don't look at the sheet and tell me. Look at me and tell me. FSP greater than 8.2795. Tell me, you will go for option or forward. Why you say I go for option? Without number, why I go for option? Because I'll allow my option to what? Lapsing the advantage of option compared to forward. Yes or no? So write down what should be written? Option. Write down option. FSP is equal to 8.2795. FSP is equal to 8.2795. What I'll do? Indifferent. I'll be indifferent. FSP less than 8.2795. Less than 8.2795. Which is better? Forward. Forward is better. I go for the forward. With this we complete question number 2 and then what? Question number 3. Both questions, the heading is what? Forward versus call option. Forward versus put option indifference part. And we also calculated break-even FSP. Is not a new concept for us. Already has been discussed in the stock options. Can I proceed or not? Now. Next. I'll give a break after I complete the next sum. 12:15. 12:20. I'll give you a break around 12:45. Okay, please. At the correct time. Can I proceed now? Take question number 4. Please. Shh. Stop talking. Take question number 4. Stop talking, please. Shh. Can I proceed? No. Your company has 12-month payable of dues mark 1 lakh. Involve yourself in the question, understand the facts. Can we start on? No. Please. Your company has 12-month payable of dues mark 1 lakh. Tell me, what is the following currency? Dues mark. Receivable or payable? Payable. After 1 year or 12 months. How many dues mark? 1 lakh dues mark. Current rate is rupees to dues mark spot rupees 20. What is the meaning of that? 1 dues mark is equal to 20 rupees is a spot rate. Is a question. Exam problem. Rupee interest rate is 21% per annum. India, what the interest rate? 21%. Dues mark interest rate is 10% per annum. In Germany, the interest rate is 10%. You are considering a forward hedge at a current forward rate of 22. An executive of another company tells you that he recently bought a call on dues mark 1 lakh at a strike price of 20 and is willing to sell it to you at a historic premium of 1 per dues mark or rupees 1 lakh for the entire contract. The call matures on the same time as your payable and is European call. What should you do is a question. Okay, now please read the question, then we can start with the solution. Shall we start? Tell me. I am having how much exposure, all of you? 1 lakh Jewish mark. Receivable or payable? Okay. Now, what is spot rate? 1 Jewish mark is equal to 20 rupees. What is the interest rate in India? What is interest rate in Germany? What is the forward rate given by the bank? 1 Jewish mark is equal to 22 rupees. That is, I can buy 1 Jewish mark after 1 year. And how much rupees? 22. What is the strike price of the call option? 20. That is, I have a right to buy Jewish mark after 1 year at 20. What is the premium they are going to charge on every option? 1 rupee. For the term of the exposure? 1 year. Tell me, 1 lakh Jewish mark payable after 1 year is riskier, not riskier? Because how much it get converted into rupees, I don't know. That is, how much is my rupee outflow, I cannot say today, because it all depends on the exchange rate after 1 year. Yes or no? I have a currency risk. Agreed? Yes, this currency risk should be hedged or not? Yes, how many hedging strategies are there? How many strategies are there? Tell me. And the 8 would in the sum, how many strategies are there? How many are there in this sum here? 3 strategies are there. Forward, money market hedging and call option, because they are given interest rate of 2 countries for money market hedge. Yes or no? Now, they are given India interest rate and also what? Germany's interest rate. Why they are given? To do the money market hedge operation. Yes or no? Money market hedge, let us see whether you remember or not. Let's start with the solution. Write down first facts. Write down facts, please. Question number 4. Right? Facts. Had you read the question properly itself, you would have got money market in mind, because heading given now forward versus money market versus option. Aduve padikiliya. No one had that. Okay, no, please. Copy the facts quickly, please. Finish copying, huh? Stop talking, please. Shall we proceed now? Facts, what happened? Can you start up? Now, write down first. Option 1. Or if you get confused, write alternative 1. Okay, option, I may think call option 1, etc. Now, okay, write alternative 1, forward, please. Alternative 1, forward. Alternative 1, forward. Let's do it together. Exposure, Jewish mark 1 lakh. Exposure, Jewish mark 1 lakh. Forward rate. Tell me what is forwarded? 1 Jewish mark is equal to how much rupees? 22 rupees. Just to get a clarity, what is 22 rupees? Today I agreed with the bank to buy after 1 year 1 lakh Jewish mark and how much rupees? 22 rupees. Yes or no? After 1 year I go to the bank, buy Jewish mark, sell Jewish mark, buy Jewish mark. By getting rupees, paying rupees, paying rupees. How much I pay as rupees here? 22 lakhs. The rupee outflow under forward option is 22 lakhs. The rupee outflow in forward option is 20 lakhs, because after 1 year I have to settle my payable now. I pay 22 lakhs to the bank and purchase what? 1 lakh Jewish mark to settle my payable. So forward cover gives me how much? 22 lakhs. Respond, yes or no? No. Next strategy is what? Next strategy is what? Money market hedge. Okay, now tell me, this is money market hedge receivable or payable? Okay. Do you all remember? Yes, sir. Now, shh. Let's see the procedure. Please. Shh. I have to buy doish mark, sell doish mark. I had what? Buy doish mark. Please. Say. Have Germany and then what? India. Okay. Now, after 1 year, I should be having how many doish mark? 1 lakh doish mark to settle my payable. Yes or no? I should be having how much doish mark? 1 lakh doish mark after 1 year to settle my what? Payable. Yes or no? Now, today in Germany, I should borrow a deposit. First I heard everybody saying borrow. Wrong. That's heart attack. I should borrow a deposit. Only when I deposit, I'll be having the doish mark to repay. Yes or no? In the case, should I deposit 1 lakh doish mark? No. How many deposit? Present value of 1 lakh doish mark. Remember or not? No. So what I should do? I should deposit what? Present value of 1 lakh doish mark. Yes or no? No. Number you can calculate later. So to deposit this present value, should discount the 1 lakh or not? I should discount using doish mark interest rate, dollar rate, rupees rate, doish mark. Why doish mark rate? I am going to deposit in Germany. Tell me what the doish mark interest rate? How much percentage here? So discount using how much percent? 10%. I calculate present value and deposit. This will be what? Mature to 1 lakh, settle my payable. Yes or no? No. To deposit present value of 1 lakh doish mark, I should buy doish mark today. Yes or no? I buy doish mark at spot rate or forward rate or spot rate. So what I do is, I borrow what? Rupees and then buy what? The doish mark at a spot rate. How much rupees here? Rupees? 20 rupees. Okay. At the spot rate of rupees 20. Yes or no? How much to be borrowed here? Present value of 1 lakh into 20 is what? Amount to be borrowed. This borrowing should be what? Repaid. Along with what? Interest. At what interest? 21%. This is outflow under money market hedge. Remember or not? We have discussed this with euro, domestic, everything elaborately. Right or not? Now, this is money market hedge payable. Simple strategy. Are you following? Huh? Can I proceed? Let's do it together. Right now. Next. Now, again, institute will be discounting and compounding using continuous rate, normal rate, normal. They don't use a continuous rate. And the call option also they use only what? Normal rate. Because we may all think that I can deposit only at what? Normal rate and borrow only at normal rate. But I say that itself is wrong. Because in the money market, there are so many varieties of bonds. Okay. I have annual coupon paying bond. I have what? Annual bonds. Zero coupon having an annual maturity. Or you can have what? Bonds which is going to credit me interest half yearly. Half yearly bonds are there or not? There are instrument deposits give me what? Quarterly interest. Deposits that give me what? Monthly interest. Even there are continuously compounded Libor bonds are not available. What available here? Continuously compounded Libor bonds are not available. Don't think, how can they credit every second interest? Don't think like that. Very simple here. Normally, a 10,000 rupee bond matures how much rupees here? 11,000. If the interest is compounded annually. Yes or no? Correct? 10%. What is the interest here? 10%. Continuously compounded bond at 10% gives you 10,000 into what? 11,000. 52 years compounded. Yes or no? Now, what they say is, instead of giving a 10% annual compounding, they say I'll give you what? 10.52% annual compounding is as good as what? Continuously compounding at 10%. We'll see how to converse these and all in the swap later. I'll find out what I'm saying. But understand that in market, again I say, everybody asks a question, sir, how can I deposit continuously? Nobody offers what? Continuously compounding interest rate. And the wrong notion is what? Wrong notion. Market, like everything available here. Except father and mother, everything is what? Available in the market. For everything they want. Joke. We cannot buy your parents, correct or not? No. Even marriage is market right there, so no. So, right or not? No. Can I proceed? No. So, anything that is, If something is that, they create an instrument for that. Understand that there's nothing that is not doable in the market here. People say, how we can have call option? Can I sell first, buy later? They brought what? Short sell. They brought into market what? That short sell. Market, this kind of financial engineering here. So many instruments is what available. If you want to continuously compound, no problem. You can what? Continuously compound. Some assets like real assets, a land or a building cannot give a continuous rent. In that case, one can use what? Normal compound. When it comes to currencies, stocks, etc., in the stock market, etc., everything is what? Possible. So it is possible to compound what? Continuously. Yes or no? In the exam problem, they compounded normally. Okay. Exam, how to know continuous or normal compounding? If they give you E value, go for what? Continuous. No E value, normal compounding. That is our simple logic for examination sake. Everybody follow not? But in Hull and all, again I say, throughout the derivative segment, they use only what? Continuously compounding. Because option cash flows are continuous. Futures cash flows are what? Continuous. Why it is continuous? You are still not learned. When I discuss about futures, how they give me the money for profit or loss, we understand why it is continuous. Are you following what I am saying? So, but exam based on the data given, continuous what? Do the normal compounding. Now, can I proceed further? Now, I hope you all have remember money market hedge or not. I made you forget now by discussing about continuous. Come back. Okay, money market hedge. I have to pay after what? 1 year. How many lakhs do you have? 1 lakh do you smart. Today I should deposit borrow. I should deposit how much? Present value of 1 lakh. To calculate present value, what should be the use discount rate? Do smart discount rate. To deposit do smart, what you should do? Borrow rupees, buy do smart, deposit. How much rupees should be borrowed here? Present value of 1 lakh do smart into spot rate. The borrowed amount should be repaid along with the interest. What interest? Local interest. Is the money market hedge? Yes or no? This was a very basic problem we discussed in what? IFM. Now it has become a complex problem. Now, we discuss money models, receivables, payables, two-way quotes, bid rate, offer rate, deposit rate, lending rate. Then we discuss about euro rates, domestic rate, which should be chosen, how leading can be what? Beneficial in the money market hedge. Everything has been discussed here. Go home and revise. Can I proceed? Now, next, money market hedge. Let's go together. Money market hedge. Option 2, money market hedge. Please. Shh. Present value of exposure. Present value of exposure. 1 lakh into, tell me what is the discounting factor? 1 lakh into 1 by 1.10. Now discount at do smart rate now 1 lakh into 1 by 1.10. I am not explaining this MMH very elaborately. We have already done in the IFM now. 1 lakh into 1 by 1.10 is equal to what? Do smart 90,909.10. Do smart 90,909.10. Invest. How much should I invest? 90,909.10 do smart at what percent? 10% for 1 year. Invest 90,909.10 do smart at 10% for 1 year. I below that write in bracket the maturity value of this investment. Below that write the maturity value of this investment. The maturity value of this investment of how much do smart? 1 lakh do smart. The maturity value of this investment of 1 lakh do smart can be used to settle. The maturity value of this, the maturity value of 1 lakh do smart can be used to settle, payables. Number doubt? The maturity value of this investment of 1 lakh do smart can be used to settle payables. In a logic, the sentence doesn't matter. Can I proceed? Next. Borrow at spot. 90,909.1 into how much rupees here? 20 rupees. 90,909.1 into 20 rupees. 90,909.1 into 20 gives you what? 18,18,182. 18,18,182. Why should I borrow 18 lakh 18,182? So that with this I can buy what? 19,909 Jewish mark and then deposit in Germany to have 1 lakh mature to settle my payable. Yes or no? Write down in bracket, right? This borrowed money will be used to buy. This borrowed money will be used to buy. This borrowed money will be used to buy what? 90,909.1 Jewish mark. This borrowed money will be used to buy 90,909.1 Jewish mark at spot. Will be used to buy 90,909.1 Jewish mark at spot to make the required deposit. To make the required deposit. To make the required deposit. Should I repay borrowing? Yes, no, no, yes, okay. We should repay borrowing. If you are a big shot, you need not repay. We are all poor persons. You have to want to repay. Okay. Repay borrowing with interest. Normally, cinema stars, industrialists, politicians never repay what? Borrowing. We only pay. Yes or no? No. Repay borrowing with interest. Please. Repay borrowing with interest. 18 lakhs 18,182 into 1.22. That's a 1.21 into 1.21. 18 lakh 18,182 into 1.21 is equal to how much? 22 lakhs. Is equal to 22 lakhs. Is equal to 22 lakhs. Under money market age, what is the cost of buying that 1 lakh Jewish mark? 22 lakhs. That's what I have to spend. This is my rupee outflow for the Jewish mark purchase. Yes or no? No. Tell me, what is the forward answer? What money market is the answer? Then what you can say? IRPT holds good. When the theoretical forward is equal to what? Actual forward. MMH and forward gives you what? The same answer. No. Not required for this, it should strike you. Respond yes or no. What, right? No. When you revise, at least here you can remember. Okay? No. When MMH outflow and forward outflow are same, when money market heads outflow and forward outflow are same, when MMH outflow and forward outflow are same, when MMH outflow and forward outflow are same, it means when MMH outflow and forward outflow are same, it means actual forward is same as. It means actual forward is same as. Actual forward is same as what? IRPT forward. Actual forward is same as IRPT forward. Do you know how to calculate IRPT forward? No. Let us check it. Okay, write down. Now. Check. Write down. Check. Check. Okay. Now, spot. 1 Jewish mark is equal to how much rupees? Rupees 20. 20 spot 1 Jewish mark is equal to rupees 20. After 1 year. This Jewish mark grows at what percent? 10%. 1 into 1.10 Jewish mark is equal to rupees 20 into 1.21. 1 Jewish mark is equal to 20 into 1.21 divided by 1.10. Hello, Papa? 22. 1 Jewish mark is equal to 22. Jewish mark is equal to 22. This is the IRPT forward. Same as what? Actual also 22. Can I put or not? Now, last option. Alternative 3. Please. Finish copying or not? No. Please, quickly. Let us complete the problem. Can I proceed? Next. Alternative 3. Please, call option. One simple calculation. Alternative 3, call option. Please. When I go for call option, I should pay for 2 things. One for purchasing the Jewish mark, another for purchasing the option. Remember, in MMH and all, I don't have 2 items. It is only what? 1. That is a pound purchase. You are going to be what? Jewish mark and then option purchase. Can I proceed? Now, first, premium paid upfront. Premium paid upfront. For every Jewish mark option, what a premium charge? 1 rupee. How much I have to pay? 1 rupee into 1 lakh. Now every Jewish mark, 1 rupee premium, 1 lakh Jewish mark, the premium is going to be 1 lakh. Premium paid upfront, 1 lakh. This premium will be paid by borrowing money or not? We have to calculate future value. Yes. This is what? Future value of premium. Imagine that I borrow 1 lakh and then pay the premium. Then I have to repay the borrowing along with what? Interest. Future value of premium is 1 lakh into 1.21. And at 21% India interest rate. Yes or no? 1 lakh into 1.21. What is the future value of premium? 1,21,000. Future value of premium 1,21,000. Can I proceed? Apart from premium, I will exercise and pay or not? No. That is, continue writing in the same slide. Exercise price. Same step you continue writing. Exercise price is equal to 1 lakh Jewish mark into 20. 1 lakh Jewish mark into 20 is equal to how much? 20 lakhs. Is equal to 20 lakhs. Total outflow. What is total outflow? 21 lakh 21,000. Total outflow 21 lakh 21,000. Please. Total outflow 21 lakh 21,000. Are you following or not? I have to pay for the Jewish mark strike price. I'm going to pay for what? Premium. Okay. Now write down conclusion. Please. Conclusion. Option rupee outflow. First, forward. Conclusion. Option rupee outflow. First item is forward. What is the forward amount? 22 lakhs. What is the money market hedge? 22 lakhs. Call option 21 lakh 21,000. Which is better? I can say call option is very much better. The reason is this 22 lakhs is always 22 lakhs. Suppose a Jewish mark is selling at 15 rupees, still have to pay what? 22 lakh. But the option, the maximum outflow is how much? 21 lakh 21,000. I even chance of paying less than that if the FSP reduces, yes or no? So the maximum outflow under our call option itself is what? Less than the outflow under the forward and money market is yes or no? Right now, next. The maximum rupee outflow in call option is the maximum rupee outflow in call option is rupees 21 lakh 21,000 is rupees 21 lakh 21,000, which is lower than the other options. In options means alternatives is lower than the other options. Under call option, there is a chance for the outflow. Under call option, there is a chance for the outflow to be even lower. There is a chance for the outflow to be even lower when FSP reduces. There is a chance for the outflow to be even lower when FSP reduces. Everybody following or not? No. Question 5, I give it as homework. Reason is 4 and 5 copy paste problem. You know what? Copy paste problem. Only thing is that Jewish mark. 1 minute, wait. Jewish mark payable. Stop. Okay. Don't stand, sit down. When you're talking, how dare you leave? Can I say? Not right. Okay, so, what I am saying is 4 and 5 is same. 4 it is payable, 5 is what? Receivable. Call option, put option. Forward sell, forward buy. MMH payable, MMH receivable. I'll just give it as homework. Okay. So we are discussing currency options, in which we completed question number 2 and question number 3, which dealt with forward versus option, indifference point and break-even FSP. Question number 4 and question number 5 deals with forward versus money market hedge versus option. We did question number 4, a comprehensive sum. I gave you question number 5 as homework because it is same as question number 4 except that it is the put option receivables we are going to have. Okay. Even calculations will not change. The inflows become outflows, outflows becomes inflows. So 5 I gave it as homework. Now please take question number 6. A very simple problem only, but one or two issues will be understood through this particular sum. Stop talking, please. No great calculations are involved, but interpretation or answering is required in this problem. Please. Shh. Once we complete question number 6, we'll do question number 1, a very small problem. It will not take more than 5 minutes to complete question number 1. When we complete these two, in the options chapter, we have the last problem regarding the foreign currency option binomial model valuation. We'll go back and do that particular problem. It is an RTP question given say 6 or 7 RTPs back. A very good question, an important problem. We'll do that particular part. If we have time, we can have an introduction to the futures. Next class onwards, we are going to go for another different chapter called as futures. It is very important. Future alone, don't miss the first class because then you don't understand how the market works and what are all the terminologies used. Ensure that in the next class you are present so that the remaining classes become very easy. Futures are regularly asked in examination. Compared to options, futures are more frequently asked. Much more simple chapter compared to the options. Please. Shh. Now let us quickly complete question number 6. A firm has participated, all of you, a firm has participated in a bid on a foreign contract involving supply of agricultural products worth Canadian dollar 100 million. The outcome of the bid is uncertain, but the CFO has bought put option expiring 6 months, coinciding with the proceeds of the contract for Canadian dollar 1 million. Strike price is 1 Canadian dollar, that is rupees 30.75 per Canadian dollars. Situation 1, 2, 3, 4. Bid is successful, FSP more than strike price. Bid is successful, FSP is less than strike price. Bid is successful, failure, FSP more than strike price. Bid is a failure, FSP less than strike price. Assume maturity prices as 30.10, 31.40, 30.75. Explain the position of the company against the 3 maturity spot prices in the event of successful and unsuccessful bid. Ignore premium, that is you don't worry about the premium paid for the option. When call option would be bought, such as exporting or importing? Will that hold good for a UK based company? Thoroughly discuss. That's a question which has been asked. Okay, now please go through the problem before I start with the solution. Please make an effort. Again I say, always put a full effort to understand, try to find the answers on your own, then the discussion will be much more clear. Please go through the question quickly. Shall we start? Okay. Now tell me. This company has made a bid for a contract. Did not? If they get that order, if they get that bid, they'll be having a receivable of how much? 100 million Canadian dollars. They are manufacturing and selling probably agricultural equipment. Don't worry about the cost of manufacturing. Indian company manufactures only in India. The equipment cost will be obviously in rupees, but they'll be releasing the amount from export. How many dollars? Canadian dollar? 100 million dollars. Now, they are going to receive this money, pay this money. They are having a receivable exposure how much? Canadian dollar 100 million. It is how many months? 6 months. And receivable exposure person will go for a call option or a put option. They go for what? Put option. Because put option only gave them right to sell. This particular firm has gone for a put option with a strike price how much? 1 Canadian dollar 30.75 rupees. That is after 6 months my firm has got the right to sell 1 Canadian dollar at 30.75. Accept that? How much premium I paid and all? Leave it. The question asks you to ignore what? Premium. Okay. I have a right to sell 1 Canadian dollar at what? 30.75 after 6 months. Respond yes or no? No. Now, see, I have not got any order till now. I only applied for the bid. I just only what? Bidded for an order. I have not got confirmed order. I don't know. Two things may happen. My bid may be successful. I may get that order. My bid may be what? Rejected. I may lose that order. Yes or no? No. The 100 million itself is not a certain inflow. It may happen, may not happen. Respond yes or no? No. As soon as I bid the 100 million, I did not wait to see whether it's going to be successful or not. Immediately went for what? A put option. Everybody following what I'm saying? No. In this case, 4 things can happen. How many things can happen here? 4 things can happen. One is, I got the order. The bid is what? Successful. And the FSP is what? More than strike price. I got the bid. And the FSP is what? Less than strike price. I did not get the bid. FSP more than strike price. I did not get the bid. FSP less than strike price. 4 things can happen or not? Yes, sir. Now what will be the FSP also don't know. Bid will be got or not also what? Don't know. So 2 into 2 uncertainty, permutation combination gives you what? 4 combinations possible. Respond yes or no? Yes, sir. Now the question is, now let us take for example 31.40. What is FSP? 31.40. You just answer. No calculation in this sum. Just answer. FSP is how much? 31.40. Now, my bid is successful. My bid is what? Successful. What is the strike price? 30.75. No need to copy. Just participate. Now, I have a right to sell a dollar at 30.75, which is trading on the day at what? 31.40. Tell me exercise and lapse. What I'll do? I'll be what? Lapsing. I'll be lapsing the option. And when I get this 100 million, what I'll do? Sell in what? Open market. And I'm going to what? Sell in open market. At how much rupees? 31.40. This is my strategy. So, other words, I allow the put option to what? Lap. And sell in the open market, how much rupees? 31.40 is the answer for the first situation. Second situation, bid is successful. I am going to receive what? 100 million Canadian dollar. But the FSP is 30.1. How much is here? 30.1. Tell me, I have a right to sell at 30.75. A dollar worth what? 30.1. Will I exercise put lapse? Exercise. I am going to want exercise put and I am going to sell at how much? 30.75. Where to go for Canadian dollar? I am already having it. I realize the order amount and then what? Sell it. Yes or no? No. Rumba simple. When bid is successful, after 6 months, I will be getting how many Canadian dollars? 100 million Canadian dollars, which I will sell in the open market if the FSP is more than the strike price. Which I sell to the writer if the FSP is what? Less than the strike price. This is the amount I am going to realize. Point number 1. Yes or no? Next. Come to the third. Bid is a failure. I did not get the order. Will I receive 100 million or will not receive or will not receive? FSP also more than what? Strike price. 31.40 is what? FSP. Strike price is what? 30.75. Exercise or lamp sum? I'll be allowing the option to what? Lapse. I don't allow say exercise option, I'll allow it to lapse. Now, last case. Bid is not successful. I am not going to get what? $100 million. I am having a put option now. Strike price is 30.75. FSP is what? 30.1. Respond. Understand? I don't have $100 million. Understand? Because bid is what? Unsuccessful. No receivable. That's what done. No receivable for me. Point number 1. Yes or no? Point number 2. I have an option. What option? Put option. I have a right to select what? 30.75. Yes, I have worth what? 30.10. Tell me, exercise or lapse? Exercise or lapse? Bid is unsuccessful, yeah? So, whether bid is successful or not will not determine whether exercise or not. Whether exercise or not depends on what? FSP and strike price, so no. Exercising or lapsing of option does not depend on my bid successful or not successful. It depends on what? FSP more than strike price or less than strike price. Exercise or lapse or exercise. I will sell at what? 30.75. By what? Buying at 30.10 and make the difference as a payoff. Respond yes or no. No. See, these are all the various things that can happen. Yes or no. Now, here, in the first case, the option is said to be a hedging transaction. What transaction? A hedging transaction. But if the transaction fails, the nature changes from hedging to speculation. Yes or no? This is very important for what? Accounting purpose. How you report the income. Okay. Now, in the first case, when I get the option, money, value for the option, that value becomes what? A hedging income. It will be what? A hedging transaction, because the option is there not to make a profit but to cover my existing exposures or not. Now, I am having the option, my bid becomes what? Unsuccessful. In that case, option is not covering a transaction. Option becomes purely what? Speculative, where this income of 30.75 minus what? 30.10, it becomes what? A speculative income. Everybody follow what I am saying? So, the transaction can be hedging or what? Speculation. You know, option market a bet only. Yes or no? Share market bet. Option holder also what? Bet. You bet upon the price movement, right or not? No. Simply a call option holder says, I have a right to buy a 30.75. He bets on increase in price. A put option holder bets on what? Decrease in price. Is making a bet without any existing transaction substantiate. If you go for an option, the option is purely what? Speculation only. If we have a transaction to cover, it becomes what? A hedging tool. Everybody follow what I am saying? That's the question here. Now, explain the position of the company against what? 3 maturity spot prices in the event of successful and unsuccessful bid. In case of successful bid, this put option will become what? A hedging strategy. In case of an unsuccessful bid, it becomes what? A speculation strategy. Is what they wanted you to answer this. Right or not? Now, up to this, let us complete and then answer the remaining 2 not related to the first question. Now, so write down. You can write in the notebook itself just for revision. Now, situation, bid, FSP. We are writing question number 6. Open the column, situation, bid, FSP, remarks. Situation, bid, maturity, that is FSP and then remarks. FSP and then remarks. Situation 1. Situation 1. Bid is what? Successful. Bid successful. FSP greater than exercise price. FSP right greater than exercise price. Now, tell me the remark. What I will do? Allow the option to lapse. Allow the option to lapse. And sell 100 million Canadian dollar received and sell 100 million Canadian dollar received in the open market and sell 100 million Canadian dollar received in the open market at rupees 31.40 and sell 100 million Canadian dollar in the open market at rupees 31.40 at rupees 31.40. Everybody, are you following or not? Now, next. Situation 2. I asked you to write a notebook because book we cannot write so elaborately, right or not? So, situation 2. Bid successful. Bid successful. That is FSP less than exercise price. Bid successful. FSP less than exercise price. Tell me, exercise or LAMSA? Exercise put option. Exercise put option and sell. Exercise put option and sell 100 million Canadian dollar received. Exercise put option and sell 100 million Canadian dollar received at a strike price of and sell 100 million Canadian dollar received at a strike price how much? 30.75. The strike price of 30.75. Point number 3. Situation 3. Bid failure. Bid failure. FSP less than exercise price. FSP greater than exercise price. FSP greater than exercise price. What will you do? Allow the option to lapse. Allow the option to lapse. I don't have any other thing to do because bid also not successful. I don't have any dollar to sell. Yes or no? Allow the option to lapse. That's it. Allow the option to lapse. Situation 4. Situation 4. Bid failure. Bid failure. FSP less than exercise price. Bid failure. FSP less than exercise price. Tell me what you will do. Exercise option. Exercise option and sell 100 million Canadian dollar. Okay, 1 million something, okay, and sell 1 million Canadian dollar. I think one thing should be 100 here. They just covered now. Now, just write any number. 1 million Canadian dollar and sell 1 million Canadian dollar. At what price? Strike price of 30.75. A strike price of 30.75. By purchasing the same in the open market. By purchasing the same in the open market at what price? 30.10. By purchasing the same in the open market at 30.10. At 30.10. Can I proceed or not? Next line. Exercising or lapsing the option is not dependent on. Next line, right? Exercising or lapsing the option is not dependent on. Exercising or lapsing the option is not dependent on. Fill in the blanks. Is not dependent on bid successful or not. Is not dependent on bid successful or not. Is not dependent on bid successful or not. Full stop. It depends on FSP prevailing on. It depends on FSP prevailing on the maturity date. It depends on the FSP prevailing on the maturity date. The FSP prevailing on the maturity date. Everybody following or not? Now, next paragraph. When the bid is successful, the put option becomes When the bid is successful, the put option becomes, fill in the blanks, put option becomes what? Hedging strategy. When the bid is successful, the put option becomes hedging strategy. How we have a forward hedging, how we have a money market hedging, we have also what? Put option. The put option becomes hedging strategy. And in case of failure of the bid, any cash flow from put option becomes, in case of failure of the bid, any cash flow from put option becomes what? Speculative cash flows. Any cash flow from put option becomes speculative cash flows. All this what we have done is part A of this question. We have now completed what? Part A of this question. Everybody having the clarity or not? Now, listen here, please. Let us discuss part B and part C together and then have the answer. Okay, now, part B. You should now be able to tell this even in dream. Okay, when call option will be bought, whether exporting or importing. I said tell in dream, don't sleep. Tell me first, when will you go for call option? Exporter goes for call or importer? Why importer? He only has a payable exposure. Call option give you a right to buy a foreign currency. Yes or no? In the case, importer goes for what? Call option. As he is going to pay what? Foreign currency on future date. Exporter goes for what? Put option, because exporter receives foreign currency. He want to sell. Hence he go for what? Right to sell. So importer goes for call option. Exporter goes for what? Put option. Is a straightforward answer B. Yes or no? Now, part C. We have part C implication. One of the futures problem later is an important question. Once they ask such a question in exam also, okay, in part C. Will that hold good for UK based company? Thoroughly discussed in an issue. Now, if you are a UK based company, will an importer go for call option, exporter goes for put option? A question arises. Okay. If you all remember, long ago, in the first class, 23rd May, 23rd November. Don't show. 23rd May also first class for the previous class for me. So no. For me, that is also first class. Okay. Allah would now come to this. Okay, now tell me. In the first class, we said that all countries gives direct quote. UK alone, they give the quotation for what? Indirect quote. In India, they give the price for a dollar, they give a price for a pound, they give a price for what? Euro, yen, etc. And then US gives a quotation for what? Euro, pound, etc. In Great Britain alone, they don't give the price for the foreign currency, they always give the price for what? Home currency. 1 pound is equal to how many dollars? 1 pound is equal to what? How many euros, and so on. So in Great Britain alone, the currency trade is not foreign currency. Home currency is traded against what? Foreign currency. Their quote is always indirect quote. Do you remember that or not? No. That's an exchange called as LIFI. That is London International Futures and Forward Exchange. Okay. In that, not only the currencies are traded, options, everything is what? Traded. One of the big currency market is that. Can I proceed? Now, in that, they create a call option not for a foreign currency, but for a home currency. They create a put option not for what? Foreign currency, but for what? Home currency. The underlying asset for the option in London is not the foreign currency, it is what? The home currency. Pound is the underlying asset and not the foreign currency. You will be able to listen now. Are you able to understand it or not? Now, ரொம்ப simple. In India, I am an exporter. In India, I am what? Exporter. And Indian has exported to US. Indian has exported to what? US. Tell me, I am going to receive, receive. Suppose I am going to receive $1 lakh, I am going to have receivable. Okay. Now, I have to sell $1 lakh after suppose 1 year. I go to my stock exchange, NSE I go. In NSE, there is a call option, there is a put option. The option is created on rupees or dollars. உங்களுக்கு யோசிக்காதியா? Now we discuss now. You go to NSE today itself, go to the website and see anytime 24/7 available. You go there and see the option underlying asset will be given as rupees or dollars. The underlying asset is what? Dollars. Dollar is the underlying asset and our home currency always going to be what? Rupees. How we have an underlying asset as share? TCS share. We have what? Infosys share, Axis Bank share. We'll be having what? A dollar as what? Underlying asset. The option is created on dollar. Yes or no? A call option gives you right to buy dollar. A put option gives you what? Right to sell dollar. I am an exporter. I am going to receive dollar what? Tomorrow. I want to sell dollar. Hence I go for what? Put option because the exchange gives me a right to sell dollar for a strike price. Yes or no? Okay. But instead of going to NSE, if I go to what? Liffey, there also call option will be there. There also what? Put option will be there. The option is not created on dollar. Now suppose an UK person is going to sell to what? US person. You want to say how many dollars here? $1 lakh receivable. Okay. UK person will sell after 1 year dollar, buy dollar, sell dollar. He is also going to receive only what? Dollar. He is going to sell dollar. Yes or no? No. When he goes to his exchange, when he goes to what? His exchange and sees the option, he cannot see dollar option at all. There's no dollar call. There's no what? Dollar put. There's no euro call. There's no what? Euro put. Everywhere you can see only pound option. Everywhere you can see only what? Pound option because in that country, they don't give a quotation for a dollar. They give quotation for what? Pound. Like that they create the option on what? The pound only. They don't create the option on the other currencies. Everybody yes or no? Now, if you see there, the quotations, they say pound call option against dollar. Pound call option against euro. Pound call option against what? Yen. Pound call option against what? Say French franc. Like that. The option is on what? Pound. Against which currency they say? Everybody follow what I am saying? Like the pound put against what? Dollar, etc. Everybody follow what I am saying? Now, for example, we have a strike price of 1 pound is equal to $1.60. Yes or no, what I am saying? Now tell me, if this is a call option, I want an answer. I go for a pound call option. I go for what call option? Pound call option with a strike price of what? 1.60. That's how they give it in the Liffey. Are you following what I am saying? Now tell me, what is the meaning of that? After 1 year, I have a right to buy pound for how many dollars? $1.60. I have a put option of pound with a strike price. 1 pound is equal to, suppose same I say $1.60. What's the meaning of this? After 1 year, I have a right to sell pound at how much dollars? $1.60. Everybody yes or no? Now, they don't create an option for a dollar. They create an option for what? Pound against a dollar. You understand the situation? Huh? That is how, suppose our country creates on rupee, how it looks like that they create on what? Their home currency, the options. Can you say? Now, come back. UK company has exported to US. How many dollars? $1 lakh. Export how many dollars? $1 lakh receivable. After 1 year, it is going to buy dollar, sell dollar. It is going to want to sell dollar. The British person says, I am not going to sell dollar, I am going to buy pound. Selling dollar means what? I give $1 lakh and purchase what? Pound. I give $1 lakh and purchase what? Pound. So they say I am not selling foreign currency. Is I am going to want to buy foreign currency because the options are created what? Foreign currency. In that case, exporter will go for selling pound, buying pound option, buying pound option. Exporter goes for a call option. Go for what option here? Call option. Because exporter is going to receive foreign currency, he is going to sell foreign currency, no problem. But there is no option for dollar, the option only for what? Pound. He does not say what is happening to dollar, he says what is happening to pound. He says I am going to buy pounds by selling what? Dollar. Since I am a buyer of the pound, I want a guaranteed purchase price or not. He goes for what? Call pound option. Yes or no? Now, suppose an importer, $1 lakh has to pay. He is going to buy dollar or not? He will not say I am buying dollar. He will be saying what? I am selling pound. Because for me, I am having only options on pounds. Selling pound means go for what option? Put option. So in British company alone, UK based company alone, exporter goes for what option? Exporter goes for what option here? Call option. Importer goes for put option. Everybody able to understand this or not? No. In one of the problem later in future, we will be seeing this particular area where some intricacies involved in the calculation part. This is what is the last part of the question. No. So write down next. Part B. Write down part B. part B, you know, write point A or point 1, part B, point 1. An importer will have to purchase foreign currency. An importer will have to purchase foreign currency to settle his payables. An importer will have to purchase foreign currency to settle his payables. Hence, he will opt for, what option? Call option. Hence, he will opt for call option, which gives him, hence he opts for call option, which gives him the right to purchase foreign currency. Hence, he opts for call option, which gives him the right to purchase foreign currency, which gives him the right to purchase foreign currency at agreed strike price, which gives him right to purchase foreign currency at agreed strike price. At agreed strike price. Everybody understanding it now? Now, next, below that write, in case of exporter, he sells foreign currency realized. He sells foreign currency realized. He sells foreign currency realized. And hence opts for what? Put option. And hence opts for put option, which gives him right to sell foreign currency. Which gives him right to sell foreign currency at agreed strike price. Which gives him right to sell foreign currency at agreed strike price. Which gives him right to sell foreign currency at agreed strike price. Shall I proceed now? Next, part C. In UK, the option contracts are not created. In UK, the option contracts are not created with foreign currency as underlying asset. In UK, the option contracts are not created with foreign currency as underlying asset. With foreign currency as underlying asset. Are you following what I am saying? I don't create option on dollars. I don't create option on what? Euros and so on. Options are not created with foreign currency as underlying asset. But the options are created with the pound as underlying asset. The options are created with pound as underlying asset against what? Different foreign currencies. With pound as underlying asset against different foreign currency. With pound as underlying asset against different foreign currency. Everybody understanding it or not? Right now, next paragraph. Thus, an importer who has to purchase foreign currency, the foreign currency to settle payables. Importer who has to purchase foreign currency to settle payables will view it as We'll view it as what? Selling pounds. We'll view it as selling pounds. So when I have to purchase dollar, I think it's going to be what? Selling pounds. We'll view it as selling pounds, and thus we'll view it as selling pounds, and thus opts for, what option? Put option on pounds, and thus opts for put option on pounds, and thus opts for put option on pounds, put option on pounds. Similarly, an exporter selects. Similarly, an exporter selects what option here? Call option on pounds. Similarly, an exporter selects call option on pounds. An exporter selects call option on pounds. For this UK company, very interesting, because when they book a profit from option, FSP minus section, when they book a profit, the profit will be in foreign currency. Everybody understanding or not? See, strike price, 1 pound is equal to $2. Simplicity, 1 pound is how many dollars here? $2. Strike price. Okay. Call option. What is the option here? Call option. On the mentioned date, a pound is trading at $3. Tell me, I'm having a profit or not? Yes. I'll exercise the call, buy the pound at what? $2. Sell in open market how many dollars? $3. I'm getting $1 profit or not? This profit should be once again converted into local currency. Because all the other option, when you have an option in a foreign currency, the profit will be obtaining in home currency. Suppose I have a dollar option in India, $1, 60 rupees strike price. The FSP is what? 62. I make 2 rupees profit, put in my pocket. It's not no. But for a British company, the problem is they'll book the pay up itself in what? Foreign currency. That should be what? Reconverter. Fatherhood hedging is required. Do you understand what I'm discussing or not now? This is the problem with respect to what? The UK based company, because they don't create option on foreign currency, they create option on what? The home currency. The profit or loss pay up itself is going to be in what? The foreign currency, that is in foreign currency only. There it should be reconverted back. All this issue we'll discuss in question number 9. That is 7, 8, 9 question we are having a UK based company futures problem. At that time we are seeing how to manage these cash flows. Everybody following what I am saying? That is why this discussion is very, very important. Please tell me, are you all following? Now, only one more question pending in this currency options in this chapter. What is the question number 1? With that, in another chapter, we have completed almost how many problems? 6 problems. And also we did the 12th sum also. Only balance around 7 problems are left out. Can I proceed? Now, take question number 1. A small question, a little bit interesting. Okay, take question number 1. Please. Shh. Exchange rate for sterling is currently 1 pound is equal to $1.5. Sterling means what? Pound sterling. Suppose you need to buy pounds at the year end. You want to be sure that regardless of the future market price, you will not pay more than 1 pound is equal to $1.6. In return, you are prepared to guarantee a minimum price of 1 pound is equal to $1.4. What option positions will provide you with this ceiling and floor? They call as caps and floors. More about caps and floors we'll discuss in the swaps later. Okay, it's called as caps and floors. Okay, now let us see what this sum is all about. Can we start or not? Now, see. What is the home currency? What is the home currency? Right. Sorry. Home currency is what? Dollars. And foreign currency is what? Pound. Accepted. Okay, sorry. Now. Okay, let us see. Simple answer. I want to ensure 2 things. First is, I don't want to pay, I'm going to purchase pound. I don't want to pay more than how many dollars for a pound? $1.6. Okay. This is the maximum I want to pay. Yes or no? Similarly, I want to ensure that I don't pay below how much? $1.4. That's the minimum I want to pay. So that is, there's a contract between two parties where we want to enter in a transaction in such a way that for this transaction, anywhere between 1.4 to 1.6, they're going to pay for the pound. Respond, yes or no? No. You are the seller of the pound, I am the buyer of the pound. I say to you, please, don't make me pay more than what? 1.6. Then you say to me, don't pay me less than what? 1.4. Both should be having a strategy to ensure both. Yes or no? This is called as cap, this is called as what? Floor. And how to ensure cap and suppose it's very simple. Both of us want to pay only 1.5. Then what happens? Enter into forward. Enter into what? Forward. I don't want to go for a forward. I want to have a range within which I should be what? Operating. I should be paying between 1.4 to what? $1.6 for the pound. Are you find the objective or not? Tell me. How to achieve this objective? Simple and how to achieve this objective? Tell me. What is the objective? Somebody say the answer here. Now, what is the objective? Tell me. Somebody said correctly. What is the objective? Buy a call. Okay, next. Exactly. Buy a call option and then what? Write a put option. Now, see. I am going to hold a what? A call option with a strike price of $1.6. I am also going to what? Write a put option with a strike price of $1.5. When we do this, what happens is we ensure that it is between 1.4 and 1.6. Please respond. Yes or no? No. How? Let us say. Take example. Take a number above 1.6. Tell me a number here. 1.7. Can I take 1.7? On the maturity date, the pound is trading in the open market at how many dollars? $1.7. Tell me, should I pay 1.7 to buy it? No. I have a call, I'll exercise it and buy it what? 1.6. Yes or no? No. And my put option holder, will he exercise or lapse? Lapse. He will not worry about it. So the call makes me pay at how many dollars? $1.6 for the particular pound. Accept it. You're going to say $1.7 1 pound here. It is actually trading in the market. In that case, will he exercise a call? Allow the call to lapse? Exercise a call. I have a right to buy at 1.6. A pound worth what? 1.7. I exercise a call and buy the pound at what? 1.7. Yes or no? No. I am only a call holder, put writer. Now, in case of put writing, I will decide other party. What he will do? Exercise put lapse. Lapse. He has a right to sell at what? 1.4. Yes, share worth what? 1.7. What he will do? Allow the put to lapse. Yes or no? What I am saying? In that case, how much I will pay? 1.6 for this particular. I will say the pound. Yes or no? No. Now, next. Opposite. Suppose the pound is $1.3. How many dollars? $1.3. Now, I am a call holder, put writer, both. As a holder of the call, I have a right to buy at 1.6. A pound worth what? 1.3. Will I exercise a lapse? Lapse. So I am very happy. Can I buy at 1.3? Why? Because I also want a put writer. My other party enforces his put option and make me buy at what? $1.4. So no, when it is below 1.3, as a put writer, I should pay what? $1.4. It is above 1.7. As a call holder, I will pay not more than what? $1.6. It is opposite for the other party also. So no, in the case, a cap and floor has been ensured. Yes, sir. Respond yes or no? No. For this, premium will be zero. I am holding a call as well as what? I am a holder of an option, writer of an option with 1.6 and what? 1.4. Tell me, will the premium be zero? No. It need not be. The reason is strike price are different, options are different. If the strike price same also, premium need not be same because put that is always call option is going to have what? Unlimited boundary. Put is having what? Limited boundary. It all depends on the stock volatility, etc. It's not what I am saying. Now, for this, somebody has to pay premium, somebody has to want receive premium. That we should calculate using what? The Black-Scholes calculator and find out the optimum premium payable or receivable for this particular range. Everybody, yes or no? No. Either we call as what? This is called as cap. This is called as what? Cap. And this is called as what? Floor. Together they call as collar. They call as what? Collar. Collar means cap and then what? Floor. Gives you the collar. Don't ask me why it is. These are names given. Can I go say? Write down. Answer over here. Write down first. Question number 1. Question number 1. In that right, point number 1. Our objective is our objective is, please don't talk, our objective is to pay not more than, our objective is to pay not more than $1.6 for a pound. Our objective is to pay not more than $1.6 for a pound. And simultaneously ensure that, we pay not less than, we pay not less than what? $1.4 for the pound. We pay not less than $1.4 for the pound. $1.4 for the pound. Yes or no? Next. Point number 1 or 2? Point number 2. The strategy to ensure this is, let's separately, hold a call with a strike price of $1.6. Hold a call with strike price of $1.6 and write a put with strike price of $1.4 and write a put with strike price of $1.4. With strike price of $1.4. Everybody following up now. Point number 2 or 3? 3. Situations. Always understand any strategy through the situations or not? Situations. Okay. Branch it into 3. First branch. FSP greater than what? $1.6. FSP greater than $1.6. Second situation. FSP less than $1.6. $1.4. FSP less than $1.4. Third situation. FSP between 1.4 and $1.6. FSP between 1.4 and $1.6. All of you should apply your mind and answer between 1.4 and $1.6. Come to first branch. FSP more than $1.6. What I will do? Exercise the call and pay $1.6. Write down. Exercise the call. First branch, right? Exercise the call and purchase pound. Exercise the call and purchase pound at $1.6. Exercise the call and purchase pound at $1.6. Exercise the call and purchase pound at $1.6. Can I go to the second branch? Now, second branch, FSP less than what? Less than what? 1.4. What I will do? The holder of put will exercise the put. The holder of put will exercise the put. The holder of the put will exercise the put and make me purchase the pound at how many dollars? $1.4. And make me purchase the pound at $1.4. Make me purchase the pound at $1.4. Everybody understood or not? Now. Third is what? FSP between 1.4 and 1.6. Now tell me, all of you think and tell. Will the put holder exercise? Exercise labs? Lab. He has a right to sell at 1.4. The pound is trading at what? 1.5. He will not sell to me all the way to what? Labs. Tell me, the call holder, I am going to exercise on labs. I am going to what? I have a right to buy at what? 1.6. Yeah, say pound worth what? 1.5. For me, call also worthless. For him what? Put also worthless. Both of us will not buy or sell from each other. We both do it in what? Outside market, open market, yes or no? So I will buy from the open market at 1.5. He will sell in the open market, how much to pay? $1.5. Everybody, yes or no? Right now. Next, third branch. both the call and put will lapse. Both the call and put will lapse. Both the call and put will lapse. Do you understand this or not? Why both will lapse? For put option, FSP is more than the strike price. Call option, FSP less than what? Strike price. Both the call and put option will lapse. Both the call and put option will lapse. And we can buy the pound in open market, and we can buy the pound in open market, and we can buy the pound in open market at what? FSP. We can buy the pound in open market at FSP. It's anyhow between 1.4 to 1.6. We can buy the pound in open market at FSP. In open market at FSP. Now, if you are awake, alert, revise, this is something similar to what? Somebody said, what is similar to what? Strangle, yeah, correct. What is a strangle strategy? And a call with what? Higher strike price and put with what? Lower strike price. What is the change? In strangle, either I hold both or write both. Long strangle, short strangle. Here, I am having a spread. I am a holder and then what? A writer. It is also not a spread because spread is on a call or put. It is what? One is on a call and is on what? Put. We call this as a caller strategy. Everybody follow what I am saying? Now, see, there are similarities. It is similar to strangle. Why it is similar to strangle here? Because call is having a higher strike price, put is having what? Lower strike price. Something similar to what? Strangle. But to call this as a strangle strategy, I will either hold the call and put or what? Write the call and put. I call them as long strangle or short strangle. How the diagram will be there for strangle? Like a tub or inverted tub. Now, so it is similar to strangle, but it is not a strangle because I am having a spread. I am having what? Spread. Because I take a position of what? Holder and writer. Yes or no? Is it a spread? No. I take a position of holder and writer. For spread, I either hold and write a call option or hold and write what? A put option. I don't have spread across options. If it is or no, no. It is not a strangle, not a spread. It is called as what? Caller. Where the call ensures cap and put ensures what? The floor. And together we call as a caller between cap and floor. Everybody following up? Right now. Next. Last point. Point number 4. The call option ensures cap. The call option ensures cap. And the put option ensures floor. The call option ensures cap. And the put option ensures floor. Together, the strategy is called Together, the strategy is called caller. Together, the strategy is called caller. Caller, C-O-L-L-A-R, caller. Okay. Together, the strategy is called caller. Okay. Now, with this, can I proceed? Area chaba. Doubt. 1, 2, 3, 4, 5, and 6. Currency option portion in the application derivative has been completed. Please.